In case you have 1 million Kenya shillings that you want to invest, would you rather put that money in the money market funds, or will you invest in dividend stocks at the Nairobi Securities Exchange? Is what I want us to look at objectively in this video. In this video, we're going to be able to understand deeply what these two investment options offer, what their returns have been recently, and also which of these options is ideal for you in what context. In case you are new here, my name is Afagzad Sifuna. I am a finance expert and qualified accountant, bringing you amazing videos about making money and investing each and every day. In case you like those kind of topics, kindly, down there is a button called subscribe. Click the button to subscribe to my channel, and also I will still add it, drop a like on this video so that you continue enjoying these amazing videos I share with you regularly. Having said that, the starting point is for us to first of all get understanding of these two options and even have a sense of what their returns were in the most recent period. MMFs are typically a way of fund managers out there pulling together funds, okay, from different investors. And of course, the barrier to entry here is very low too, because even with 1,000 Kenyan shillings or whichever small amount of capital, you can invest in MMFs. When they pull together these funds, the respective fund managers typically invest that money in short-term assets, like for example, treasury bills, like for example, commercial papers, you name it. And that way, they are able to make some money for the investors. Of course, they also deduct their management and transaction fees from all these, but they avail investors an opportunity for them to gain something. And typically, the range of percentage gain in MMFs annually is somewhere between 5% to about 80%. Like for example, capitals like for example, Nabo Capital had about 10% return, okay? Others like for example, Saiton, Etika MMFs and the likes had 8-point-something% returns on their MMFs, which tells you it's quite a decent return on MMFs. But the main advantage of MMFs is that the accessibility to that money is very high. In case you want, for example, to withdraw your money from MMFs, you're going to be able to access it even within 24 hours, 48 hours, you name it. And that is why, typically out here, they are considered liquidity buffer. For someone, for example, who wants to save emergency fund, instead of saving liquid cash, whether having the cash in hard cash or saving in a bank account, which is not paying them an interest, they rather push that money to an MMF because either way, they'll be able to access that money on short notice. So they are considered liquidity buffers most of the times. Even though some investors also invest there for the long term, they are looking at the annual increment, assuming an MMF is constantly performing very well. Because their returns do fluctuate, they are not fixed. Okay? And then, let's now look at dividend stocks. What are dividend stocks? Dividend stocks at the Nairobi Securities Exchange are those stocks of mature companies. What do I mean? You see, any company out there typically has a growth curve. It's starting, it begins growing, okay? At some point after years of growth, typically at least 10 years plus, it becomes a mature company, right? And there's a difference between growth company or growth stock and mature stock. Growth stock is stock for those companies which are on the trajectory of growing. They are still working very hard to grow. For example, they need money. Once they get a profit, they need their profit to be plowed back to business, either through expanding operations, opening new branches, in improving the technology they have, you name it. And then on the other side, these dividend stocks or mature company stocks are for those companies which are already mature. They have systems, they are proven to be making profit, they have very distinct competitive advantage and dominance in their sector, so they're most likely going to continue being profitable. And a chunk of investors love dividend stock from those companies because they give them dividend annually, whereby dividend is basically the company sharing in part of their profit with shareholders. Case in point, a company might get a profit of 10 billion and the board could decide they are going to pay a dividend of 2 billion, 20% of their profit. That is going to be distributed among the outstanding ordinary shares, therefore making investors out there enjoy a benefit, which is dividend. And the dividend, based on the rate computed per share, you're gonna get a dividend yield. Investors out there really love these companies because of their potential to get dividends each and every year. More so, those companies which are proven, they do pay dividend. And in Kenya, we have some of the amazing dividend stocks because there are companies which have really proven that. Case in point, companies like, for example, BAT. Rarely do you see the BAT stock at the NSE fluctuate a lot, but BAT is a very mature company which pays dividend. And even last year, BAT did pay dividend absolute number of 70 shillings on each of its shares. Therefore, making its dividend yield to be somewhere between 14% to about 15% depending on what your base share price reference looks like. Okay? Same goes for companies like, for example, Standard Chartered Bank, Stanbic. All these companies had dividend yield upwards of 10%. Other like, for example, EABL, okay, Equity Bank, and a good chunk of companies in the banking sector, Safaricom, they all had dividend yield upwards of 6%. That tells you that's the reason as to why investors love these mature companies. Despite there being small movement on the share price, the real benefit for them is in these dividends which they're going to get each and every year. You having understood that, and you being an investor at the NSE or even having capital which you are looking to utilize to invest at the NSE or even invest in alternative asset classes out there, let me first of all mention a mistake which investors make when they are deciding between MMFs and dividend stocks, and then share with you what is ideal. Okay? So the biggest mistake is that they do compare these two asset classes in a way that is wrong. And I'm saying so because, remember, MMF does only give you a given return in percentage on your investment, right? And then dividend stock does have two elements of returns. There is the dividend, which is paid annually and then yields a given yield, which is dividend yield. And beyond that is share price appreciation potential. And to give you an example, assuming you put 1 million Kenya shillings, please note these are assumptions. I'm not saying they're factual, okay? If, for example, you put in an MMF which pays you 8.5%, it's going to mean at the end of the year, assuming you don't offset your capital, your return, capital plus the benefit you're going to get is going to calculate to 1,085,000 Kenya shillings, right? Because of the 8.5%, right? And then on the other side, assuming there's a company which even pays lesser dividend, right? Maybe at 7%. That company might be paying lesser dividend, but then again, it has something called share price appreciation. Because also at the Nairobi Securities Exchange, investors also benefit from shares prices going up. And as a result of that, it is share price appreciation, which when an investor is cashing out, it connects to capital gain. So assuming the share price appreciated by 15%, and then they did get a 7% on dividend yield, that investor who put down 1 million at the start of the year is going to enjoy the 7% plus 15% on share price appreciation, which is going to calculate to about 1.22 something million Kenya shillings. That is a much higher return compared to the MMFs. But then again, we need to be looking at that objectively because also in the stock market, the price of shares might dip, therefore causing an investor to experience something called share price depreciation, the opposite of appreciation. In this example, I looked at it with a positive outlook, given we are assuming, for example, the company did increase in its share price. You having understood that, which of these two investments is an ideal one for you, assuming you are looking to put money on either of them? Guys, I think both of these investments are amazing investments. It just depends on your risk appetite and your investing horizon. Simply put, what level of risk are you willing to absorb? And secondly, what time are you looking at for you to be able to enjoy benefits from these particular investments? For MMF, they are more secure compared to dividend stocks. Reason being, you are most likely going to get a return given the model which MMFs operate utilizing. They get your funds, they invest in short-term secure assets, like for example, treasury bills, commercial papers, you name it. So your money is more of kind of like slightly more guaranteed. I'm not saying fully guaranteed because there is risk and levels of risk also are quite high in MMFs compared to other asset classes, but at least the default risk is highly minimized, okay? Therefore, given the default risk is highly minimized compared to investing in dividend stocks, it means that your investment is a bit more secure in MMFs, right? And then the second thing you need to understand also is that depending on a time horizon, if, for example, you are looking to invest for only maybe 6 months or even 1 year, because you are saving money towards maybe unlocking school fees for next year, it is better to put your money on MMFs because MMFs are going to avail you the possibility of capital preservation and, secondly, a small return on top of your initial investment. And beyond that, you'll be able to access this money on short notice compared to you investing in the stock market, where once you put your money in the stock market, remember also the prices can depreciate. Therefore, you having a risk of capital depreciation. In case you are looking at a long-term time horizon, maybe 5 years, 10 years, 20 years, I think the best bet for you on this will be investing in dividend stocks because, as you've seen, it has better returns because you're going to enjoy the possibility of share price appreciation and also dividends, which, in case you plow back year in, year out, is going to mean you'll be able to build wealth because of the power of compounding. Guys, I think that's the lens with which we need to be looking at this investment, as opposed to just waking up and arbitrarily saying this is better than the other one. Once you look at all these factors, really analyze your financial goal, why you are investing in the first place, your time horizon, then you'll be able to settle on one of the best investment options among these two. And of course, for certain investors out there who have huge amounts of capital, they do invest across different asset classes and enjoy the benefits of all these asset classes. Guys, I hope you got a thing or two from this video, which you can utilize in your own analysis or even in making informed decisions as you are investing in whichever asset class out there. Cheers, guys. Look forward to share with you other amazing videos next time. Bye-bye and take care.